Welcome to the deep dive. This is where we take that pile of complex financial docs, tech reports, all that stuff you send us, and turn it into something clear, something actionable. And today, wow, we've got a really interesting one. We're not just looking at a company doing well, we're diving into a massive, like, high-speed transformation happening right now at Clearwater Analytics.
Yeah.
You'll see it as SWAN.
CWAN. And if you follow investment tech at all, you probably know Clearwater. For years, they've been sort of the king of the back office, right? Super sticky, great margins, mainly serving the big institutional investors.
Exactly. That sticky, reliable back office solution. But that's changing and changing fast. They've made this huge strategic pivot. They're moving out of that safe niche and they're aggressively going after this title of a full front-to-back investment management powerhouse. I think their leadership actually called it the nervous system of the future investment management industry.
That's a bold claim, nervous system. But it captures the ambition, doesn't it?
Yeah, it really does. And to help us, wrap our heads around this shift, you sent us some excellent material. We've got detailed analyst reports, initiating coverage. There's a really interesting investor deep dive discussion laying out the bull versus bear cases.
Yeah, that was good.
And crucially, the Q2 2025 earnings call transcript. That was the first time we really got a good look at the results of this whole strategy playing out.
First real numbers post-acquisition frenzy.
Exactly. So our mission today is pretty clear. We need to unpack this massive $2 billion M&A strategy that's fueling everything. We need to really scrutinize the financials, especially those Q2 numbers that, frankly, surprised a lot of people.
Definitely raised some eyebrows.
And then, at the end of the day, figure out if all this execution risk they've taken on justifies the discount the market seems to be putting on the stock right now.
Okay, well, to really get where they're trying to go, I think we absolutely have to start with where they came from, the origin story.
Right, Boise, Idaho, wasn't it?
Yeah, Boise, Idaho. Started by fixed income managers. And it wasn't glamorous, wasn't some fancy front office trading platform. It started as a solution to a really painful problem. Automating investment accounting, compliance, reporting, all that back office headache.
The stuff nobody wants to do, but absolutely has to be right.
Exactly. And the funny thing is, the founders, they realized their internal tool, the reporting thing they built, it was way better than the actual investing product they were using it for.
Huh. That's kind of ironic.
Totally. So they spun out the tech. And that foundation, that laser focus on just solving the complexity of the middle and back office, that's really the source of their big advantage today, I think.
So even before all these recent acquisitions, they were already a pretty major player.
Oh, absolutely. Before this big M&A push, the core platform was already managing, get this, over $8.8 trillion in assets. Trillion with a T.
Wow.
Across more than 1,000 organizations globally. We're talking huge insurers, asset managers, corporate treasuries. They're deeply embedded in the critical day-to-day operations of these massive clients.
Right.
And that embeddedness, that's the engine, right? The high-margin, durable engine they're now using to build this bigger empire.
Okay, let's unpack that. We hear sticky thrown around a lot in SaaS, right? But Clearwater stickiness, it seems almost legendary. You mentioned the core business, pre-acquisitions, had a gross revenue retention rate consistently around 98%.
Yeah, 98%. That's phenomenal.
Yeah.
It's practically perfect for enterprise software, especially in financial services where, let's be honest, switching tech providers is incredibly painful.
Right, it's a nightmare.
Exactly. So that 98% number, it basically tells you only 2% of their revenue is churning out each year. It means once they're in, they become part of the furniture, part of the operational DNA, like you said.
Almost impossible to rip out.
Pretty much.
Yeah.
The switching costs are just immense.
So what's the secret sauce there? It can't just be a nice UI or good support. You mentioned the architecture. That single source of truth idea?
Yes. That's the core differentiator. It all comes down to their architecture being cloud native from the start, and crucially, it's a single instance multi-tenant platform.
Okay, break that down. Single instance, multi-tenant. Why is that specific setup such a competitive moat for things like compliance and reporting?
It's the data moat. Simple as that. Think about how the legacy guys operate. A big player like SS&C, they usually have a whole suite of products, often bought up over years, maybe decades. Think Advent, Geneva, lots of different names.
Right, patched together.
Exactly. And these systems are usually separate. Often they're installed on-premise at the client site. And fundamentally, they just don't talk to each other easily. They weren't designed to.
Okay.
So imagine you're a big institution using these old systems. If you want to do your end-of-day reconciliation or generate some big regulatory report, you literally have huge teams of operations people, data specialists, whose whole job is just forcing these separate systems to agree on the same number.
Like, does the trading system match the accounting system? Do the risk numbers line up? That sounds messy.
It's incredibly messy. It introduces massive complexity, huge costs, tons of potential for errors.
So if I'm using, say, 3 different legacy systems for my front, middle, and back office, I've basically got 3 different versions of my own portfolio reality, and I need a whole army of people just to argue about which one is right.
That's a great way to put it, precisely. And that's where Clearwater just completely disrupts that whole process.
Yeah.
Because they use one single security master database and one single data plane for all their clients. Data consistency is just baked in from the start.
Okay, so give me an example. How does that work in practice?
Right. Let's say take a specific corporate bond.
Right.
Maybe an insurer over in Munich holds it, and a big asset manager in New York holds the exact same bond.
Okay.
Now, let's say the ops team in Munich finds a little error in how its interest accrual is being calculated, or maybe how it's classified for regulatory purposes. They fix it because it's a single security master.
The fix immediately updates for everyone holding that bond.
Instantly. Okay. Across the entire platform, globally. So that New York asset manager gets the benefit of that correction immediately, without their team having to do anything, without them even knowing maybe.
Wow. Okay, so it's like a network effect, but for data accuracy and compliance.
Exactly. A network effect for data cleanliness. Yeah. It just eliminates that massive need for what the sources call the professional services burden. You know, all those consultants and internal teams just manually reconciling stuff.
Which can cost a fortune on the old systems, right?
A fortune. Clearwater standardizes it, automates it. And that's why clients don't leave. The cost, the sheer manual labor involved in trying to replicate that consistent data feed yourself, it's just way too high.
Okay, that architectural edge makes total sense, and you can see how that would flow right through to the financials of that core business, even before the big acquisitions.
Absolutely. They were textbook, beautiful SaaS metrics. Revenue growth was consistently strong, you know, in that 22% to 24% year-over-year range. I think core revenue in Q2 2025 hit about $130.6 million.
Pretty solid growth.
Yeah, but the margins are the real standout.
Right.
The core accounting and analytics business. They hit GAAP gross margins over 79% in Q1, and then in Q2, they actually ticked above 80%.
80% plus gross margin. That's pretty rare, isn't it?
It's very rare, especially at scale. It tells you the software is highly standardized, doesn't need a lot of manual handholding, and it's delivering huge value compared to what it costs them to run it. And they hit that target, that 80% goal, which was a long-term goal, in just 2.5 years after their IPO. Pretty impressive.
And what about growth from existing customers? That net revenue retention, or NRR?
Still really strong. Core NRR was holding steady at 114%. So they're not just keeping 98% of the revenue. Those existing customers are actually spending 14% more each year on average, buying more modules, adding more assets. It just confirms that value prop. They deliver and clients spend more.
Okay, so the core business was, as you said, beautiful. High growth, amazing margins, crazy retention. A perfect little engine, really.
Right. Predictable, profitable.
Which makes the next move even more dramatic, right? The decision to spend roughly $2 billion. That's like a third of their market cap at the time on 3 big acquisitions, basically all at once.
Yeah, that was the moment everyone sat up and went, whoa, okay, what's happening here? It wasn't a toe in the water. It was a dive head first.
They bought Infusion for $1.5 billion, Beacon for $560 million, and then that suite with Bistro and Wilshire Analytics. This wasn't just adding features. This was a fundamental strategic leap. It takes them right out of just the back middle office and puts them smack into the front office game.
It was basically a declaration, wasn't it? A declaration that the old way of doing things, with separate systems stitched together, was over. They recognized that if they wanted to grow faster than that solid 20-something%, they couldn't just be the best back-office plumber. They had to own the whole house, the entire investment life cycle.
And that move obviously changes their potential market size, right?
The TAM. Immediately. Yeah. Massively. Their total addressable market jumps from around $17.5 billion, which was mostly focused on that core accounting and reporting piece, to $23.3 billion. Suddenly, they're competing head-to-head in the much broader front office space. Order management, execution, risk management is a whole new ballgame.
Okay, let's break down the pieces. Infusion was the biggest one, $1.5 billion. That brought in the front office OAMS, the order and execution management software. But the sources, they kind of hint that Infusion wasn't exactly firing on all cylinders when SWAN bought them.
That's putting it mildly. And that's where a lot of the execution risk comes in, the risk the market is worried about. Infusion had made its name serving hedge funds, smaller launches often. But as they tried to move up market into bigger asset managers, they apparently ran into some trouble. Scaling issues, the product maybe wasn't quite hardened enough for those bigger clients.
So operational turbulence.
Yeah. Exactly. And it showed up in the numbers. Their retention, which used to be great, like 97%, had slipped down into the 92, 94% range. That's a big drop. And their profitability took a hit too, probably because they were spending a lot trying to catch up on product development for those demanding larger clients.
Okay, so Clearwater pays $1.5 billion for an asset that was kind of a leaky bucket retention-wise and needed more investment. How does that math work? What's the plan there?
Right. It sounds counterintuitive, doesn't it? But the thesis, fan thesis, is all about synergy and stabilization. Their plan seems pretty surgical. First, stabilize Infusion. Apply their own really rigorous SaaS operational playbook, the same one that got their core margins over 80%. Stop the bleeding, shore up that retention.
Apply the Clearwater discipline.
Exactly. Then, second, and this is the big revenue upside, use Infusion as the dedicated front office weapon to cross-sell into their huge, stable, existing customer base. All those insurers and big asset managers who already trust Clearwater with their most critical back-office data, now they can offer them the whole integrated suite.
Okay, so fix the base, then leverage the cross-sell. Makes sense. Now, what about Beacon? $560 million is still a lot of money, especially for risk analytics. What exactly does Beacon bring to the table that's worth that much?
Beacon is the complexity engine. It's all about sophisticated risk analytics, quant modeling, and really importantly, alternative asset modeling. Today's portfolios aren't just stocks and bonds anymore.
Right. Private credit, PE, infrastructure, all that less liquid stuff.
Exactly. All that opaque stuff. And managing those assets, reconciling them, reporting on them accurately, calculating regulatory capital for them, it requires really intense, complex data models. Legacy systems just choke on that stuff.
Because they were built for plain vanilla stocks and bonds.
Right. So Beacon, combined with what they got from Bistro, gives them that expertise instantly. It fills a massive tech gap. It makes the combined Clearwater offering immediately relevant to the most sophisticated players, hedge funds, big insurers who are dealing with these complex portfolios every day. It lets them move upmarket fast.
The speed of all this is kind of mind-blowing. Buying 3 companies, integrating them. Yet management sounded really confident almost immediately. They talked about client validation.
They did. They hit the road hard right after the deals were announced. Management said they met with over 450 clients globally, specifically to pitch this integrated vision and see how it landed. And the feedback, according to them, was near unanimous enthusiasm.
Really? Why such enthusiasm?
Because clients instantly got the logic. A single, unified front-to-back platform solves that massive headache everyone has, stitching together multiple vendors, dealing with messy integrations. It's the dream, really, for any large asset manager's COO.
Okay, so the vision resonated. But vision is one thing, execution is another. We do have a pretty big proof point already, though, right? Especially in that crucial insurance market.
Yes, the VKB win, that was huge. For Sichering Scammer Group, they're the largest public insurer in Germany. And they didn't just buy a piece of Clearwater. They ripped out a major legacy provider and went all in on the full front-to-back solution. Core Clearwater accounting, Infusion for the front office, Beacon for risk, the whole package.
Wow. Okay, so that's significant. Why particularly?
Well, it validates 2 key things. One, that this integrated platform story isn't just slideware. It actually works and is attractive in a massive, important market like German insurance. And 2, crucially, it shows Clearwater can displace those big, entrenched legacy vendors when they come armed with this unified offering. They can actually win the rip-and-replace deals.
And then there was the integration speed itself. That synergy number was pretty staggering. The sources said they hit $20 million in expense synergies within days. That was supposed to be the target for the whole first year.
Yeah, that number jumped out. $20 million in run rate savings almost overnight.
How is that even possible? Does that mean the companies they bought were just incredibly inefficient? Or is Clearwater's integration process just that good? What did the earnings call suggest?
Probably a bit of both, honestly. The acquired companies clearly had some operational fat that the Clearwater team just attacked immediately, redundant roles, overlapping systems, that sort of thing. But it also really highlights the power of Clearwater's own model. Because they're cloud native, single instance, They didn't need months to build new data centers or integrate databases. They could basically just apply their standardized, efficient architecture and shared service model onto the acquired businesses almost instantly. They restructured the org quickly around verticals like insurance and hedge funds, and boom, the efficiency showed up in the margins right away.
All right, so this massive debt-fueled pivot, what did it actually do to the combined company's numbers? Let's get into those Q2 2025 results. Analysts were definitely holding their breath, especially worried about margins getting crushed.
Yeah, everyone was watching the margins. But first, the top line. The growth numbers look pretty spectacular, as you'd expect after spending $2 billion. Total revenue hit $181.9 million. That's up 70% year over year.
70%, huge jump.
And total annualized recurring revenue, ARR, reached $783.5 million. That's up 83% year over year. Massive growth. But here's the really key part for the bulls. The organic ARR growth, the growth from the original Clearwater engine, that stayed strong at 20%.
Okay, that's important. So the core business didn't stall out while they were doing all this M&A integration.
Exactly. The original engine is still humming along nicely.
Yeah.
But yeah, the margin story, that was the real shocker, the triumph, really. Analysts were absolutely right to expect margin compression. Clearwater's core gross margin was up near 79–80%, right?
Right.
But Infusion's gross margin was historically way lower, like 69%. So you blend those together, especially with Infusion being such a big acquisition, you'd expect the average to drop significantly.
Makes sense. What was the expectation?
The street consensus, the analyst expectation, was for a blended non-GAAP gross margin of around 76.5%. Seemed reasonable.
And what did they deliver?
They delivered 77.4% non-GAAP gross margin in Q2.
Wow. So better than expected, but how much better relative to the plan?
Get this. They had committed to delivering about 400 basis points, or 4%, of gross margin improvement on the Infusion business over the entire first year post-acquisition. In this first quarter, they basically delivered almost all of that already.
In one quarter, they achieved nearly the full year's synergy target on gross margin.
Pretty much. It was an incredible result.
Okay, let's pause on that. What does that immediate margin expansion actually prove? Is it just cost cutting, or is it that architectural efficiency really kicking in?
It signals a few really important things, I think. First, yes, the cost synergies were real and happened fast. Decommissioning redundant systems, consolidating hosting, all that. But second, and maybe more importantly, it shows their ability to standardize and automate those core functions. Reconciliation, data management, reporting using their single data plane is way more efficient than how Infusion was doing it standalone.
So the CWAN model, that efficiency engine, it's transportable. They could apply it to the acquired assets right away.
It looks that way. It really seems to be their secret weapon against that legacy complexity and inefficiency that plagues so much of the industry. They prove the model works, even on acquired assets.
And did that flow down to overall profitability too? What about adjusted EBITDA?
Yep, the good news continued there. Adjusted EBITDA margin came in at 32.1%, which was actually 70 basis points higher than Clearwater standalone profitability back in Q2 of 2024.
Wait, so they bought lower margin businesses, integrated them, and their overall profitability margin increased?
Increased. Year over year, that's the definition of strong operating leverage and really efficient synergy capture. They bought scale, slammed their efficiency playbook onto it, and the results were immediate.
Okay, incredible execution on the P&L side. But what about the balance sheet? This was all paid for with a lot of debt, right? That adds risk. Where do they end Q2?
Good question. Yeah, they ended Q2 with $872 million in total debt. It's a significant number. But they're also generating a ton of cash. Operating cash flow was $47.1 million just in Q2.
And are they paying down the debt?
Immediately. They paid back $50 million on their revolver, their credit line, right within the quarter. And management sounded really confident on the earnings call. They guided their leverage ratio, basically their debt compared to their earnings, their adjusted EBITDA would be, and I quote, very comfortably below 4 times by the end of this year.
Getting below 4x leverage that quickly after such big deals, that would definitely de-risk the story quite a bit, wouldn't it?
Absolutely. For investors worried about the debt load, hitting that target so fast would be a major confidence booster. It gives them breathing room, flexibility for the future, too.
Okay, one last metric from Q2 retention. We know core NRR was 114%. What about the consolidated numbers, now including Infusion and Beacon?
Right, so the consolidated numbers obviously reflect the weaker profile of the acquired assets, particularly Infusion's lower retention history. Consolidated gross retention is still very strong at 98%.
Okay, so the acquired customers aren't fleeing en masse. That's good.
Exactly. The stabilization plan seems to be working on that front. but the consolidated net revenue retention, NRR, is currently 110%.
So lower than the core 114%, but still positive expansion.
Right. Still means the average customer is spending 10% more year over year. But the long-term target for consolidated NRR is 115%. So there's still work to do. Management's path to get there is basically twofold. Keep improving the operations and product in the acquired businesses to stop any remaining leaks, and then really drive that cross-sell. Getting Infusion and Beacon into those core insurance clients is key.
Mm-hmm.
Okay, so if we step back from the quarterly numbers and look at the bigger picture, Clearwater seems to be hitting its marks financially, but they're also riding some pretty powerful tailwinds, right?
Mm-hmm.
Macro trends, regulatory stuff that just makes their solution more necessary.
Definitely. Let's talk about those growth drivers. You mentioned regulation, especially in insurance. That seems like a big one.
Huge. Insurance is about half their customer base. And the NAIC, that's the National Association of Insurance Commissioners, they rolled out a major policy change that just took effect in January 2025.
Okay, what does this change do? And why is it such a headache for older systems?
It completely changes how insurers have to classify their fixed income investments, their bonds. Before, they could largely rely on standard credit ratings from S&P or Moody's. Pretty straightforward.
Right.
Now they have to use much more complex factors, deeper analysis of capital charges, risk profiles. It goes way beyond just the letter rating.
Okay, sounds more complicated.
Way more complicated. And for legacy systems, it's a nightmare. Those systems are often rigid. They rely on manual inputs, simple lookups. They just weren't built to handle these kinds of complex, constantly evolving calculation methods for thousands of securities.
So insurers using old tech basically have to do it manually. Spreadsheets and prayer.
Pretty much. Lots of manual workarounds, which is slow, expensive, and super risky from a compliance perspective. So this regulatory change is a massive push factor. It forces insurers stuck on old platforms to seriously look for modern, cloud-based systems like Clearwater that can actually handle this data complexity natively. It's a huge driver for new business.
Okay, that's a powerful external catalyst. Then there's the whole boom in alternative assets, right? Private markets.
Absolutely. That's fundamentally reshaping what an investment portfolio even is. It's not just liquid stocks and bonds anymore. You've got private credit, private equity, infrastructure funds, complex derivatives.
Stuff that's hard to value, hard to track.
Exactly. Opaque is the word.
Yeah.
And managing that opacity, modeling the risk, reconciling the holdings, reporting on it accurately, it requires a platform that can handle that complexity in near real time.
Yeah.
Legacy systems, again, they just weren't built for this. They were built for daily prices on listed securities.
And this is where Beacon and Bistro really come into play.
Precisely. That's why those acquisitions were so strategic.
Yeah.
The combined Clearwater platform can solve this huge organizational problem where, say, the investment team needs a really specific data cut, like what's our exposure to software companies within this specific private equity fund?
Yeah.
But getting that answer means days of bothering the back office accounting team to manually dig through spreadsheets.
Right. Slows everything down.
Totally. By getting all asset classes onto that single data plane, Clearwater lets those front office teams get those complex answers themselves in real time. It shifts the burden of complexity away from the ops team and empowers the decision makers. That's huge value.
Okay, regulatory push, alt asset pull. Then there's the tech advantage itself. The AI and data flywheel you mentioned earlier, that data isn't just about efficiency now, it's about future products, right?
Exactly. That single logical database holding clean, reconciled data across $8.8 trillion plus in assets. That is Clearwater's massive competitive advantage when it comes to AI, especially generative AI.
How are they using AI today?
Right now, it's mainly driving internal efficiency. They have a platform called Helios. It's their proprietary data reconciliation tool. It uses machine learning to ingest documents, read them, figure out what they are, and intelligently route any discrepancies or exceptions for fixing. That's a big part of how they expanded gross margins so quickly in Q2. Automation.
Okay, so efficiency gains today. But the future, the real money, is about making the platform a revenue generator, not just a cost saver.
That's the vision. The plan is to monetize that incredibly rich, unified data set using what they're calling Agentic AI.
Agentic AI, what does that mean?
Think of it like AI systems that can do more than just answer a simple question. They can understand a complex situation, reason through multiple steps, and actually take actions or provide sophisticated, multifaceted answers.
Okay, so less like a chatbot, more like a digital analyst.
Kind of. So instead of a CIO having 5 analysts pull 5 reports from 5 different systems and spending 2 days arguing about the numbers,
Yeah.
the idea is future Clearwater products will use this agentic AI to answer incredibly complex questions in seconds.
Like what kind of questions?
Imagine asking the platform, okay, given the current market volatility and our latest regulatory capital constraints, what is my total exposure to the German currency right now across everything? Public bonds, private credit hedges, derivative positions, even the underlying currency exposure in my international equity funds.
Wow. Answering that today would be a project, a multi-day project involving multiple teams.
Exactly. Days of manual data gathering and consolidation.
Yeah.
If Clearwater can let a CIO or portfolio manager get that answer instantly just by asking, that fundamentally changes how investment decisions are made. And that justifies a much, much higher price point for the platform. It moves it from a back office cost center to a front office strategic weapon.
That's a powerful vision. Now, moving into that front office space, providing those kinds of analytics, it means bumping up against the existing giants, right? Like BlackRock's Aladdin, Bloomberg's AIM. How are they handling that, especially Bloomberg?
Yeah, you can't ignore the incumbents. Their strategy, particularly with Bloomberg, seems quite smart, actually, very pragmatic. They recognize that for the really huge, global, multi-country asset managers, Bloomberg AIM has a super strong, entrenched position on the trading desk, the front office.
Hard to displace.
Very hard, very costly to fight that battle head on. So instead of declaring war, they partnered with Bloomberg.
Bernard.
They built a bidirectional integration. It basically allows these huge enterprise clients to keep using Bloomberg AIM for their trade execution, which the traders love, but then seamlessly pipe all that trade data instantly into Clearwater for the accounting, the compliance checks, the performance measurement, the risk reporting, all automated.
Ah, so it eliminates that clunky manual workflow between the front office and the back office for those giant clients.
Exactly. It means Clearwater doesn't have to win the bloody battle for the trading desktop at those mega firms. They can just provide the best, most integrated plumbing for everything after the trade happens. It's a co-opetition strategy.
And is that working? Are clients biting?
According to management on the Q2 call, yes. They said this partnership is already fueling over a dozen active deals with large enterprise prospects. It shows they're thinking strategically, compete hard where they have the edge, mid-market, insurance, but collaborate smartly where it makes sense at the very top end.
Okay, one last tailwind, maybe simpler, but still important. The interest rate cycle.
Yeah, it's a nice little kicker. A portion of Clearwater's revenue, maybe 2–3% they estimated, comes from fees based on assets under management, AUM.
Oh.
They charge something like half a basis point on some client assets.
Okay.
So if and when interest rates eventually get cut, what typically happens? Bond prices go up.
Right.
When bond prices go up, the total AUM reported on Clearwater's platform goes up. And bingo, Clearwater gets a little revenue boost, literally just for a market movement. It's a nice direct tailwind built into the model.
Yeah.
Okay, so pulling all this together, strong core business, incredible stickiness, surprisingly good execution on these huge acquisitions, powerful tailwinds. And it really brings us back to that key question for investors. Why is the stock trading at a discount compared to its peers?
Yeah, let's quantify that discount. The analyst reports we looked at CWAN trading around 7 times forward revenue. Meanwhile, you see other top-tier vertical sauce names, think AppFolio in property tech, or Procore in construction trading more in the 9x to 10x forward revenue range, sometimes even higher.
Right. And arguably, Clearwater has maybe even better organic growth and a clearer path to strong free cash flow than some of those names. So 7x feels low.
So what's the market worried about? Why the discount?
It really comes down to what the analysts are calling the noise and the perceived execution risk around the M&A. Investors, it seems, just aren't fully convinced yet that the integration risk is truly behind them.
Even after those strong Q2 results.
Even after Q2. I mean, Q2 was great, but it's just one quarter. The market seems worried about the sheer scale and speed of doing 3 major deals at once. Can they really stabilize Infusion's retention long term? Can they consistently hit those cross-sell targets? Will the debt burden become an issue if growth hiccups? It's still very much a show-me story for a lot of investors.
They need to see a few more quarters of consistent execution before the multiple expands.
That seems to be the sentiment. The market wants proof that this complex integration is fully bedded down and the growth synergies are sustainable before it's willing to pay that premium SaaS multiple.
Okay, integration risk. What about the private equity overhang? That seemed to be another factor mentioned. PE firms like WCAS sold a lot of stock.
Yeah, that adds another layer of complexity to the narrative. Over the past year or so, the original PE backers, Welsh Carson mainly, They sold down huge chunks of their stake, something like 20% of the entire company changed hands.
So on one hand, that gets rid of a potential flood of supply hitting the market later.
Right, clear the overhang?
Exactly. That's the bull argument. It's good, gets that liquidity event out of the way. But the bear argument is, well, why are the insiders, the people who presumably know the company best, selling down so aggressively right now, just as this big transformative growth story is supposed to be taking off?
Yeah, that does raise a question. Are they signaling they think the easy money has been made, or that the risk is higher than management is letting on? It's the classic PE exit debate. The bulls say they just had fun timelines, needed to return capital to their own investors, the LPs, and the market provided a good exit window, standard procedure. The bears worry it means the PE firms saw the peak valuation based on the promise of the strategy and decided to get out before the reality of the execution risk really played out.
But there's a counterpoint there, too, right, about governance.
Yes, importantly, even though they've sold down shares, PE representatives still have significant influence, particularly on the board's compensation committee. And guess what? They've structured management's compensation, big equity grants, to be heavily tied to hitting that aggressive 20% plus growth target.
So even as the PE firms cash out some chips, they've still got management laser focused on delivering the growth needed to make the whole strategy work.
Precisely. The incentives are strongly aligned with executing the growth plan. So the PE selling might be less of a negative signal than it first appears.
And then speaking of signals, the company itself sent a pretty strong one recently with the share buyback, didn't they?
They did, announcing a $100 million share repurchase program right after Q2, especially after taking on all that debt for the acquisitions. That's a pretty confident move. It's management basically saying, we think our stock is too cheap right now given our durable growth prospects.
Putting their money where their mouth is, essentially.
Exactly. It's a signal they believe the market is overly discounting the execution risk and underappreciating the long-term potential.
So how do the analysts translate all this into a potential valuation? What kind of upside are they seeing if Clearwater executes?
Well, the math varies, obviously, but one approach we saw looked at fair value based on where the company could be in, say, 2 years, assuming they hit their targets. They applied a multiple to the projected free cash flow, using about a 30x multiple on 2-year forward free cash flow, which translates to about a 3.3% free cash flow yield. Pretty reasonable for this kind of business. That analyst got to a price target in the mid-$20 per share.
Mid-$20. And where is the stock trading now, roughly?
When these reports came out, it was more in the high teens. So that mid-$20 target implies a potential internal rate of return, an IRR, of over 25% from current levels, assuming they execute over the next couple of years.
A 25% plus potential return if they deliver? That's pretty attractive.
It is. And it's all underpinned by those long-term financial targets management has laid out. Hitting 20% plus consistent annual revenue growth while also expanding adjusted EBITDA margins to 40% plus over the next 3 to 5 years.
40% plus EBITDA margins, that would be elite territory.
Absolutely. If they can achieve that combination of durable 20% plus growth and 40% plus margins, that current valuation discount, that gap between trading at 7x revenue versus peers at 9x or 10x, that should disappear pretty quickly as the M&A noise fades and those cross-sell synergies really start kicking in. Hashtag tech.
Okay, let's try and consolidate the key takeaways from this deep dive into Clearwater analytics. It's quite a story. First, we really established the power of that core foundation. That cloud-native architecture is the bedrock, delivering incredible efficiency, 80% plus gross margins, and that amazing stickiness, the 114% core NRR.
Right. The core engine is best in class. Undeniably strong.
Second, the execution on the really ambitious M&A strategy seems, so far at least, surprisingly successful. They captured those synergies way faster than expected, hitting that 77.4% blended gross margin right out of the gate. It really defied the fears about margin collapse and kind of validated their operational model.
Yeah, that Q2 performance on margins was a major positive surprise. It showed they can integrate effectively.
And then finally, looking forward, their growth path seems pretty well supported. They've got multiple strong drivers, that aggressive push internationally, the whole structural shift towards alternative assets needing better solutions, the regulatory hammer forcing modernization, especially in insurance.
The NAIC change is big.
And then that underlying tech advantage. That single database, the data mode, positioning them really well for the future of AI, potentially shifting them from just back office plumbing to front office intelligence.
It's a compelling set of growth vectors for sure.
So a lot going right. But maybe a final thought for our listeners to chew on.
Yeah, I think there's an interesting tension here. We talked a lot about the stickiness of the core business, right? That 98% gross retention. It's built on the idea that once Clearwater is in, it's just too hard, too risky, too expensive for clients to rip them out. It relies on essentially customer inertia.
Right. The pain of switching is too high.
Exactly. That's the foundation.
Hmm.
But the future growth,
Yeah.
hitting that 20% plus target consistently, especially with the new acquisitions, that relies on completely different dynamic. It relies on Clearwater being aggressive, on actively going out and ripping out those entrenched legacy competitors in the front office, the middle office, globally, especially in those complex asset classes.
Hmm. So the core strength comes from customers not leaving, but the future growth requires forcing competitors' customers to leave.
Precisely. The foundational advantage is passive, the difficulty of leaving Clearwater. The growth acceleration demands aggression, making it compelling, maybe even necessary, for clients to leave their current vendor for Clearwater. So the key question I think you, the listener, should ponder as you watch this company evolve is this. Is that passive advantage of hard to leave us as powerful as the active challenge of making others switch to us? Especially as Clearwater rolls out these fully integrated products in phase 2 and phase 3 of their strategy and really goes after that global market share. It's a different muscle they need to build.
That active versus passive dynamic, that really captures the challenge and the opportunity here. Fascinating stuff to watch. Well, thank you again for helping us break down all this complex material. Hopefully, this deep dive gives you the clarity needed to track this transformation. We'll see you next time on the deep dive.